Wells Fargo is just out in the last maybe 10 or 15 minutes or so with their numbers. Wells Fargo shares right now down about 2.5%. Now, this is a big mortgage lender, right? So people look towards this company for some signs of what's going to happen with mortgage lending, maybe commercial operations. Well, let's get through the numbers. 74 cents in earnings. That does miss analyst estimates of roughly 81 cents per share. Also, $17 billion rather in total revenues. That also misses analyst estimates that we're looking for around $17.5 billion in total revenues. They do also point out that they do expect to see credit losses increase, albeit from very low levels that are currently at right now.
What does this mean, ladies and gentlemen, when we say credit losses and them missing expectations? Now, what we're talking about is analysts that were expecting for Wells Fargo to hit certain estimates or benchmarks, and they didn't hit those benchmarks, which is one of the reasons why Wells Fargo is down today. Obviously, the market reacted. But more importantly, if we're really paying attention to what he's saying, he's communicating to us that Wells Fargo expects for people to be taking losses as it relates to loans. Now, let's break this down a little bit, right? Banks make money from lending out money. That's the biggest thing. When the pandemic hit and everybody put their money out of the markets and things like that, and they put all of their money into the banks, largely banks make money from lending out your money. Now, how does that make sense, right? We're talking about the servicing of loans in which they have to then be a little bit more careful of who it is that they're lending out to. The sweet spot is not the people that actually can qualify for the loans the most. It's not the people with the best credit, the people with the highest income. Obviously, they want them because is less risk associated. The part where banks make the majority of their money is when people don't qualify for the best, which means that they can charge the highest rates, but it's a lot more risk involved, which is one of the reasons why we have the gamification of credit to try to figure out who can and can't support their loans and who we can give money to so that we can make sure that they can actually pay it back. We want to make the most money possible from it, but then at the same time, we want to make sure that you can actually pay it back. So this is saying that Wells Fargo is missing estimates from revenue generated because they were expecting to generate a certain level of revenue, but they didn't. All right, so let's continue.
And that they do not see any meaningful deterioration yet in either their consumer or their commercial portfolios. But on balance, the earnings and revenue miss. There was also a miss on their net interest income as well. On balance, that's a 2.5% decline.
Net interest income. Net interest income. Income net from interest. Okay? They're making money off of servicing the loans. Let's continue.
For Wells Fargo, and we know the financials have been on this kind of downtrend, not just Wells Fargo, but other financials as well for quite some time.
So let's scroll up a little bit, right? I wanted to start off with that video, but let's scroll up real quickly because Wells Fargo profit is falling as a result of the bank is putting aside money so that they can make sure that they can account for bad loans. There's going to be write-offs. They understand that it's a lot of people that have loans that cannot necessarily meet the obligation of the debt. And so they're starting to go through and say, you know what? We anticipate this much of a loss and we're setting aside money for that so that we can account for that at a later date. Let's scroll down a little bit and then let's deep dive into this Argo. They said that second quarter profit declined 48%. So let's just say, for example, 50%. Let's round it up for the sake of numbers, right? Let's say that they made $50 million second quarter profit, right, from a year ago. And then this year, they make $25 million. So that means that the profit declined 48% or 50% from a year earlier, right? They're making less money than they did a year ago. From a year ago, as the bank set aside funds for bad loans and was stung by declines in equity holdings. Here's what the company reported to compare it to what Wall Street was expecting. Now, one of the reasons why it's important to look at this and look at the earnings reports is because you can sort of anticipate what other banks are going to be reporting once you start to read a lot of these or you see a lot of these revenue estimates miss or makes or over, actually they are much more successful than other banks because they're anticipating the losses that come along with servicing some of these loans and people not being able to make the payment on these loans. Let's see, 82 cents adjusted versus 80 cents expected. Adjusted meaning that you have different accounting procedures that put revenue up or down, and then revenue of 17 billion versus 17.53 billion. Now, revenue, ladies and gentlemen, and I want to teach y'all to understand how to look at these earnings reports, and I want to help you to understand from a C student's perspective exactly what this means. Revenue does not mean how much money that they made. It means how much money that they generated, right? That was the amount of money that they generated, but then their costs and everything associated with it, the profitability is based off of the net. So it's almost like if I go in and I'm running a business and I sell a burger, right? And I make $100,000 in sales of burgers in my restaurant in that month. But then I have expenses. I got employees, I got rent, I have costs associated with buying those burgers and all of the materials, for that particular business. I have the Coca-Cola guy. I got to make sure I pay the air and the electricity and all of the utilities, and I got accountants and all of this other type of stuff, right? After you adjust all of that down, how much money do you have left? You may have made $20,000, so you made $100,000 gross, but your net revenue or your net profit is actually only 20 because 80,000 of that had to go into running the business. Okay, excluding the impairment. Hold on, wait. You see what I'm saying? Profit of 3.12 billion or 74 cents a share. And a lot of people will look at that number and they say, well, that's pretty freaking good. They made $3 billion. But they made $3 billion compared to making $6 billion, $6.04 billion last year at the same quarter. So this year they made $3 billion or 74 cents a share compared with $6 billion last year or $1.38 cents a share. So it's not necessarily that they're still profitable that people are paying attention to. They're paying attention to growth. Why are you losing money? What is happening in the economy? Are people not being able to pay their loans? Why are you allocating resources to be able to cover the people that are going to default on their loans? And how can you anticipate people defaulting on their loans? And then what does this mean for other banks? What does this mean for whether or not I should continue to invest in banks? What are the headwinds that's coming? Are we facing a recession? And so now I'm starting to show you why it's easy to start to use the different data points and why we use numbers from yesteryear and what was the context behind how they were able to make more money last year than they're able to make more money this year, and what are the headwinds, what are the problems, and so on and so forth, in order to make more informed decisions as to whether there's going to be a recession, how is inflation affecting people, are people spending habits higher or lower, when the Fed raises interest rates, are people less likely or more likely to still take out these loans, are people paring back their spending, so on and so forth, right? Because banks make money off of servicing all loans that they issue, credit cards, mortgages, personal loans, so on and so forth, right? And so they want to understand what is happening in the economy, and you can use these reports to start to get a better understanding as to how people are moving within society and whether or not we're going to be facing a recession. All right. It said excluding impairment, the bank would have earned 82 cents a share in the quarter, edging out the 80 cents per share estimates from analysts. So it's saying that including one-time fees and things, tax purposes and things like that, their adjusted earnings would have been a little bit different. Shares of the company jumped 6.6%, a sharp rebound from declines in pre-market trading. While our net income declined in the second quarter, our underlying results reflected our improving earnings capacity, with expenses declining and rising interest rates driving strong net interest income growth. So let's break this one statement down, okay? Expenses are declining, meaning that whatever it is that they're using to drive the cost out of doing business on a regular basis. It could be they're getting rid of buildings, people are working from home, they're having more people do or less people doing more work, which drives up revenue. Whatever the expenses are, they're going down. They're driving out expenses. They laid out some people. No, they didn't. But I'm just using it as an example. And rising interest rates, meaning that the bank makes more money off of servicing your loan. So when you go and you look at your statement and you pay whatever your loan is that you owe in your credit card bill, right? And they're able to charge you more interest, it means it drives more revenue. lower costs, raise revenue, but then they're allocating monies for people that are potentially defaulting on the loans. All right. So I just wanted to give y'all a little bit of insight of what's going on and how it is that we're able to get a little bit more insight as to what is happening in the economy and how people are moving, how we're able to anticipate certain things. And when you read these reports, and I study these reports and I look at the earnings reports that come out on a quarterly basis from certain companies, and then I might deep dive into something else depending on what it is that I'm looking for, it helps me to understand of exactly what's going on in the economy and how I need to move more strategically with different companies that I may want to invest in. All right. So just giving you some insight. Make sure you subscribe to the Patreon. The link is in the description as well as pinned to the top of the chat. We're doing some phenomenal things there. I'm actually in New York right now because tomorrow I'm doing a Patreon exclusive meetup. If you are in the New York or New Jersey area, you want to kick it with your boy, Rita and Q is out getting foot massages. I don't know what they're doing. They out here in these streets having a good time in New York. We're gonna be kicking it. All right. So the actual location and the time and everything is in the Patreon. In addition to that, we're doing some phenomenal things. Make sure you tap into the Discord that's a part of the Patreon. Make sure that you rocking out with us with a group of people that's going in the direction that you want to go in. We all pour into each other. We got mastermind sessions that unlocks when you join the Patreon. We have a build a business series where I'm showing you how to build a business from the ground up using my own money. And it's awesome. It's lessons and work that you get and that you can't learn in a university. I don't care what business class you go to. All right. So, and if you want to kick it with me personally, email me at antondaniels413@gmail.com. We're going to get you set up. We're going to get you taken care of. And we're going to make sure that everything stays popping. I love you. I appreciate you. I'm going to holler at you guys later. Peace.